My father was a member of the Bombay Stock Exchange. How stocks can create massive wealth. Bajaj students can relate because they've played the game.
And how did you get the idea to start a company and your own venture?
He was an ugly investor in stocks like Pantaloon when no one knew of them. And how supply chains usually work, how economy works, how markets work.
What should we do if we face any crisis ahead?
In those days, the worry was which Indian banks will survive. That anybody and everybody who invested in 2008 today has yielded fantastic returns. Not all unlisted stocks provide great value.
Silicon Valley Bank crash.
The asset liability mismatch that the bank created for it. It's the most suicidal thing to do in markets. It was certain that now Trump is going to be the next US president. Corporate tax rate from 21% to 15%.
Hello everyone, welcome to JBIMS Wealth Creators Podcast. My name is Kalpesh Kinage and we are pleased to have our guest Amit Sahita with us, who is a founder of Fincode and a JBIMS alum of 2004 batch. In this part of podcast, we'll be having a bit aspect of his professional and personal life, and then we'll dive deeper into finance. So sir, I would like to know little about your personal and professional life. That I get to know that your father was in BSc. So might that be a chance it has fascinated you and that made you choose your current profession? So
my father was a member of the Bombay Stock Exchange, and that definitely played a part in my choice of career. Because since a very young age, I was exposed to conversations about finance, and dinner table conversation would be about Harshad Mehta or Ketan Parekh or the delivery processes of Bombay Stock Exchange and margining systems, settlement mechanisms. In those days, Badla was very prevalent. So from a very young age, I was exposed to all of that. And I still remember vividly as a 13-year-old or a 14-year-old going to Muhurat trading in the open outcry ring in the Bombay Stock Exchange. And because of that exposure, I definitely was more inclined to move to financial markets.
And so what was the idea and how did you get the idea to start a company and your own venture, Fincode?
So it was a process, it was a slow and steady process in which we decided to have our own company. What happened was when I started off, I was informally advising a lot of my friends, cousins and acquaintances about how to plan their finances, about how to plan their investments. Over many years, from one friend it became 10 friends and so on. And eventually in 2014, we decided that it should be a more formal arrangement, because what we realized that informal advice is not executed in the best possible manner. So let's say if I advise you something that, I think in your particular situation, let's say this kind of stock exposure and this kind of exposure to other investments is a good idea. You may execute some part of it, but not as professionally as a professional would. So to combine the advisory and the execution part of it, we started our venture as a firm in 2014. And as the venture grew, and we grew to around 700 odd clients from 2014 to 2020, we converted into a private limited company to make it into a more formal structure. And today we service more than 1,000 clients at Fincode.
That's great. So as you have graduated from one of the prestigious university, JBIMS, there are that you have been taught by the best professors in the country. So there might be some guidelines that you have taken by your professors and you follow them in personal and professional life.
So I have many fond memories from my days at JBIMS. And one of my fondest memories is when one of our finance professors, Shivanand Mankekar, he used to conduct our classes for financial management, and he used to take us through the entire process of how he invested. He was an early investor in stocks like Pantaloon when no one knew of them. So he bought Pantaloon at 40 rupees, which eventually went all the way up to 2,800 rupees. He was an early investor in financial technologies at some 15 rupees, and the stock went up all the way to 3,000 rupees. And he narrated many such stories. So that was a huge influence in my life as to how stocks can create massive wealth if the right kind of process and the right kind of research is put into place. Another story that is very dear to me is of Sandeep Gokhale, and he used to teach us corporate finance, and he explained to us how Balco was taken over by Sesa Goa. Now, Anil Agarwal's Sesa Goa taking over Balco was a very big thing in those days, because Sesa Goa was a very small company as compared to whom they were competing with, which was Birla's. Even with only 25 crore rupees at their available to them, they managed to take over a 500 crore company in 1996. And we had the privilege as students that Sandeep Gokhale, who was instrumental in this entire takeover, explained to us how he convinced not only Mr. Anil Agarwal to do this, but he also helped him execute this entire process and competed against the Birlas, who were much bigger, and succeeded at this. Another favorite story of mine is the game that Mr. Moradian makes all the students play on day one. It's a favorite story of mine because it teaches us, for maybe Bajaj students can relate because they've played the game, it teaches us the vagaries of the supply-demand chain and how supply chains usually work, how economy works, how markets work, how there are huge days of exuberance, and those huge days of exuberance are usually followed by huge days of disappointment. Also, the fact that Mr. Moradian teaches us so beautifully with the book called Goal by Eliyahu Goldratt. Have you read the book Goal by Eliyahu Goldratt? Okay. Maybe you're not. Maybe Mr. Moradian has not been coming in the recent years. But it's a beautiful book. It talks about processes. It talks about manufacturing. It talks about how to build processes and systems. And it also talks about bottlenecks. Right. So I like to believe that I have built my ventures with the learnings of Mr. Mangekar on the financial side, but also Mr. Moradian on the processes side. So the learnings have been tremendous. I remember another favorite instance of mine. We had a professor called Shiv Kumar. He eventually went on to become the CEO of Nokia. He spent 19 years at Unilever and a few years as CEO of Philips. And he used to come and teach us and share with us his practical experiences at Unilever, at Philips, and he was also on the board of Godrej. So he used to also share his instances of the board of Godrej. So if I really if I really look back to all the times in those 2 years that I spent with so many other professors besides the 4 that I mentioned, Professor Faki, Professor Tinaikar, Professor Pia Mukherjee, it would be a separate podcast by itself. I'm really thankful to all of them.
Yes. Sir, as you have experienced the 2008 crisis, what was your learning at that time, and what would you like to say, and what should we do if we face any crisis ahead?
So the 2008 crisis was unique in the way that we, in the midst of the crisis, saw not only Bear Stearns, one of the largest US brokerages, fall, we also saw Lehman fall. We also saw 2 very huge housing finance companies in the US, Fannie Mae and Freddie Mac, fall. And in those days, the worry was which Indian banks will survive. So I remember ICICI Bank, there used to be huge queues outside ATMs. And people were convinced that ICICI Bank will not survive. And every institution be it an IndusInd Bank or be it an ING Vysya Bank, were threatened of survival itself. The one learning from this entire instance where we saw the Sensex fall from 21,000 to 8,000 in a matter of 8 months is that we will continue to see such crises from time to time because of the interconnectedness of our markets, be it the US market and the Indian market. But investors need to be invested according to their long-term asset allocation programs only, and need to be mentally prepared to see such drawdowns on their equity portfolios. So their equity asset allocation should be assuming that we could see such a meltdown, say tomorrow. Only then will they be able to see through it. Having said that, anybody and everybody who invested in 2008 today has yielded fantastic returns.
Right. So one financial service that FinCode provide is to buy and sell unlisted shares like NSE and CSK. So are those shares having the same potential like the current share are trading in the market?
So before I get into the unlisted part of it, I would like to mention that FinCode provides a plethora of services. We are into financial planning and wealth management. As a part of that wealth management service, one of the services we provide is the buying and selling of unlisted securities. So what happens is that companies have early investors. Let's say you mentioned NSE.
Yes.
So NSE had early investors like State Bank of India, LIC, GIC. And these early investors may want to sell before the listing happens. So we have seen LIC offloading certain amounts of shares in the public markets via a certain process that they follow. So we enable our investors to be able to buy those shares directly from LIC as and when LIC declares it would like to sell. Again, in other companies like CSK, we've seen that the branches of India Cements have sold certain stocks early, other early investors have sold. Typically ESOPs issued to employees, they also get sold if employees want some liquidity at their end or they see some value release. Also sometimes regulators make it mandatory, like I remember IRDA had told LIC that you should decrease your stake in NSE to a certain extent. So sometimes regulatory requirements from SEBI, from RBI, from the IRDA, Insurance Regulatory Department Authority, the Development Authority, makes it necessary for these companies to sell their stakes. So coming back to the second part of your question, that do I see value? In certain cases, like NSE, where there is a monopoly and the company is extremely well run and strong, yes, but not in all cases. I would advise investors to be extremely wary of investing in unlisted stocks. Do their research well before doing it. Not all unlisted stocks provide great value.
So there are much greater risks.
There are many great risks in investing in unlisted stocks. They are not as liquid. You cannot easily buy and sell, and it's an opaque market. It's a market also based on a network of brokers who know each other, who trust each other. But outsiders may not enjoy the strengths that the brokers enjoy.
Right. So two of the most known services provided in the market is also provided by FinCode. Those are PMS and mutual funds. So which ones should an individual choose, and which can provide a greater return in future to their clients?
Let's quickly understand the difference between a PMS and a mutual fund. PMS is a very customized product. So the SEBI has mandated that only investors investing above 50 lakh rupees can invest in PMS in a particular PMS. So mutual funds obviously is a mass market product, and I would advise PMS only for those experienced and sophisticated investors who have investable surpluses of more than 5 crores. Because if you invest 50 lakh rupees in a PMS, it brings in a certain level of not only risk but also illiquidity.
Right.
I'll just explain with an example. Let's say you invested 50 lakhs in a PMS and you invested, another example, you invested 50 lakhs in a mutual fund. If you want to redeem 5 lakhs for some emergency or for some use, you can very easily do that in a mutual fund. But in the PMS, you cannot do that. You have to redeem the entire 50 lakhs, and that will have its own tax outgoes. So for common investors with limited surpluses, mutual funds are a far better vehicle of investing. And for more sophisticated risk-taking investors, PMS provides an opportunity to take higher risk to chase higher returns.
That's the reason why PMS is not allowed to advertise their products.
PMS can advertise their products in a very limited way, to a limited audience with certain guidelines.
Right. So with the current economic situation, which is the one sector that you look at that will be continuing the wealth generation?
So when we are evaluating sectors, at FinCode we have a very strong set-in process, a process that has stood the challenges of time, and we have evolved that process over a period of time. So when we are comparing sectors, we compare them at valuations, government push, demand levers, and economic data. We have a lot of economic data that is released by the government on a monthly basis. We have access to not only what is the credit growth, what is IIP, what are the IIP figures, what are the PMI figures, what are the figures of diesel consumption, what are the figures of electricity production, what are the figures of metal consumption. And when we are churning out those figures and we are digesting those figures, our process tells us which sector to go towards. Right now, we are more focused to incrementally investing sums in the banking sector because the valuations are the most at their lowest for a while that we are seeing for the private banks especially. Also, I would like to mention that we prefer to invest in sectors which are out of fashion. We are not going to chase the next hot thing. We are looking for what is exactly out of fashion right now, and banking is out of fashion according to valuations.
Right. So as you said that currently you are watching out a banking sector. So can I have a view about the Silicon Valley Bank crash?
See, Silicon Valley Bank crash was a very particular instance that happened in the US, and it happened because of the asset liability mismatch that the bank created for itself. Right. The bank's customers were startups and they were investing short-term monies with it. But the bank, on the other hand, had gone out and leveraged itself and was betting on long-term bonds. So when the interest rates in the US went from 0 to 5.5, the bank was caught on the wrong foot because its leveraged positions that it had taken at or about a 1% interest and 1.5% interest were in deep losses at when the rates were at 5.5%. So it's a very isolated instance. In India, Indian banks don't leverage like this. I myself have worked in a bank treasury for a while, so I can tell you that Indian banks are some of the safest banks globally. And the SVB case is a completely different case. Indian banks are a completely different case altogether.
They have invested wrongly.
They invested short-term money in long-term instruments with leverage. Right. It's the most suicidal thing to do in markets.
So currently, just yesterday, international gold prices fall by 4%. So due to the election of US in which Donald Trump has won. So what's that correlation of US election and international gold market, and what will that affect in India?
See, the largest liquidity provider globally is the US Fed.
Yes.
It is not only the largest central bank in the world, but has more access to more money than any other institution. All risk assets, be it US equities, be it emerging market equities, be it other European equities or Japanese equities, or risk assets like gold, are constantly being discounted by the US Fed rate. What I mean by that is, if the US Fed rate goes higher, available liquidity for all these risk assets goes lower. As soon as Trump was elected, it was certain that now Trump is going to be the next US president. The markets were certain that the rate of interest rates coming down in the US is now going to be lower. See, the US Fed rate was 5.5. It was decreased by 0.5% a couple of months back. Yesterday it was decreased by another 0.25. But now the market knows that the rate is going to decelerate because of Trump. Because Trump, he's going to decrease taxes and going to lead to more borrowings and more fiscal expansion for the US. As soon as the market realized that the rate of cuts is going to be decelerating, gold fell because the amount of liquidity available for all risk assets is going to fall.
Correct.
The only risk asset that went up because Trump came were US equities, because Trump has also promised to bring down the corporate tax rate from 21% to 15%. Otherwise, if you look at all risk assets, be it Japanese equities, be it European equities, be it Indian equities, be it other emerging market equities, they have all fallen because now the US Fed rate cuts will be decelerating.
So, thank you very much, sir, for your valuable insights and your valuable time to be here and giving us your knowledge and experiences. So, that was it for the first part, and we'll be coming up with the next part, which will be hosted by Vishal.